Welcome to Age, Pension, Super and Retirement. I am your host Yvonne, and as always, this podcast is information only and never personal advice. In today's episode, we are looking at tax and ownership structure, and I'd like to welcome back Gayle McKew from Prosperity Planning Partners. Hello, Gayle.
Good morning, everyone. Nice to be here.
It certainly is. Can we start with what is capital gains tax, Gayle?
Some people hate it, and other people go, yeah, actually, this is the price I pay for making a profit on the purchase of an asset. And that's the way I look at it. It's also something that can be managed. So way back in 1984, the 20th of September is the magic day, 1984. The federal government decided in their wisdom that we should tax profits made on the sale of some assets. And that's where capital gains tax came in. So for somebody who has a share portfolio, or they have an investment property, or they have a managed fund that has gone up in value, then you're likely to pay capital gains tax on it. But if you had purchased prior to the 20th of September 1984, you can have what they call pre-CGT assets. And those pre-CGT assets can be shares, collectible items. I forgot to mention collectible items, so gold and silver and other collectible items. They're considered to be a CGT asset. And effectively, those pre-CGT assets are capital gains tax-free until either sold by the original owner or the person's date of death. And when I say the person's date of death, what happens is death for every single one of us is considered to create a cost base for the assets that we owned prior to our death.
That's really helpful, Gayle, and all those categories are interesting. Just going with one of these examples, if someone was to get pre-capital gains tax assets, such as they were given a piece of jewellery back in 1975, then that piece of jewellery, if it's handed down through the generations, does that remain exempt, or when it changes ownership, it starts again?
Technically, when it changes ownership, it should have a different cost base.
Right.
But generally speaking, collectible items like a piece of jewellery that are more sentimental rather than financially valuable,
Yes.
that's a different story, because most families don't actually ever sell them. They just pass them down through multiple generations.
Okay.
But if something is inherited and then sold, then they are going to want to know the actual cost base to be able to calculate the likely gain. So, for example, if I'm going to use my grandma, she died way back in 1984, February 1984. I inherited her engagement ring. Now, I am never going to sell that because it's an emotionally attached asset for me. But I don't think it's actually worth very much if I took it to somewhere that would buy it from me. So if I took it to a secondhand store or a pawn shop.
Yes.
If you took it to a pawnbroker, they would basically go, oh, Gayle, that will give you X number of dollars for the gold, and the diamonds, they're worth nothing because they were very low quality. And I know that they are low quality diamonds. So I would probably have a very small capital gain if I wanted to sell it. But for some people, they might have inherited a house.
I was going to say, what happens if that was a house?
So if they had a house that had been purchased in, say, 1975 and they inherited it in 2025, think about what the property market has done. From the time of the purchase by the original person to the date of their death, that would be a capital gains tax-free amount. So let's say it was a house that had been bought in a western suburb in Sydney. Now, they probably might have spent 20 grand on it originally. But if it sold for $1,020,000, I'm doing this for simplicity, the $1 million increase, that $1 million to $1,020,000 would be capital gains tax free to the date of death.
Mm-hmm, mm-hmm.
But anything past that $1,020,000 that it sells for suddenly becomes an assessable capital gain.
Okay, so at death, then there's a whole set of rules depending upon what's done and in what period of time. But that's
correct.
Okay, that's so helpful. Thank you, Gayle. Now, sort of connected to property, but can I ask, what are land taxes?
They're different things for different states, and technically they're not a tax. They're referred to as a tax because the only organisation in the country that's legally allowed to apply a tax is the Australian federal government. So these are state-issued levies that are referred to as taxes.
Very interesting. Now, for those that have listened to part 3 of our wealth transfer, I just have to sort of tie all this in a little bit. With the ownership structures, joint tenants in common, which was in our part 3 of our intergenerational wealth transfer, and survivorship, what taxes...
Do you want me to quickly go over that?
Yes.
Just so that people know exactly what we're talking about?
Thank you.
So basically, bank accounts, shares, managed funds, they are known to be assets that are bought as joint tenants because they can't be purchased as tenants in common. Property is really the only thing that can be purchased as tenants in common. Traditionally, most people have purchased their family home under the format of joint tenants. And the difference between a joint tenant and a tenant in common is that the tenant in common person can elect to make a decision as to where they want their specific portion of that asset to be bequeathed to. So now let's go into the next part.
Yeah,
So
basically, thank you so much. Any tax implications, since we're talking about tax on this?
Okay, so technically, yes, there can be, but in 99% of instances, they are ignored when somebody inherits the other half of the family home, because the family home is a capital gains tax-free asset. So what happens is, if we use something purchased back in 1975 for $20,000, if person A and B had purchased the house and B died, A would get the full value of the house at whatever the current value is. Technically, they inherited a cost base for that property. Person A inherited person B's cost base, which technically would have changed at date of death. So it went from an exempt asset to a taxable asset technically, but because it's a family home, which is CGT exempt, it sort of slides under the radar.
Yeah, no, that's really interesting, Gayle. Is there any story or anything that you can think of as far as ownership structure goes and tax, maybe again an unintended consequence?
We've only actually just talked about the family home. We haven't talked about any investment properties.
Okay.
Because if we go back into that, and survivorship says that this is an investment property, and 99% of it was owned by person A and they passed away, and person B suddenly gets a 99% of a home or an investment property, they actually inherit the cost base of the original owner. And this applies to any shares and any managed funds that are inherited. People think, oh, there's no capital gains tax. There's this sort of, we'll turn a blind eye temporarily view held by the tax office. But when you sell that asset, they go, hang on, what's the cost base? How much is your capital gain? And your cost base is the cost base of the person who originally purchased them.
This is really interesting. It's a whole series of unintended consequences again, but this time, rather than disinheriting people, we're talking about paying unexpected taxes.
Yep, you've got that covered. Because I literally had somebody say to me not long ago, their parent had died, want to keep these CBA shares because they pay a really good income, blah, blah, blah. And I mean, you do realise that you inherit their cost base, and that means you inherit their tax position when you sell them, don't you? And they went, what? No. I went, no, this is the law, because they'd been told that you just, whatever you inherited them for, you didn't have any capital gains tax. But because those assets were purchased post 20 September 1984, or the person died after that date, they suddenly have become capital gains tax assets.
Wow. And I guess in a way, when you just mentioned shares, would that be really tough sometimes finding a paper trail for these pre-September 2085 shares?
Yeah, it can be. But what we have found, I've gone back and had to look it up recently for a couple of clients. We had most of the information, but we didn't have it all. But I could go back onto some of the old historical share prices, just figure out roughly, or because there's a difference between a record date and a payment date when it comes to dividend reinvestments or to other dividends.
Yes.
So you've actually sort of got to go back and know those sort of details to make it
wow.
work.
So it's not just when, I guess what you're saying, it's not just as simple as shares were purchased pre this date. If it was, as you say, ongoing dividend
reinvestment.
that must be a nightmare to untangle.
Yes, it is a little bit.
Yeah, look, no, I think it's a very interesting, and tax-wise, can anything be clawed back then after death tax-wise? Or
No. Basically, if somebody's sitting on a carried forward loss, you can, and I say this to people all the time, a carried forward loss exists while ever you're still breathing and you have a heartbeat. But as soon as you stop breathing and you don't no longer have a heartbeat, that carry forward loss is lost because it relates to the individual. The other thing to bear in mind is most people don't sort of realise you have to do a tax return for a deceased party as at the date of death, and because they're treated in one way and that's their tax liability up to that point. And then you have to do one every year while an estate's being wound up.
That's so interesting. I can imagine a lot of people not realising that one.
Yeah, it can be a nasty shock, to be honest.
This is really helpful, Gayle. It's one of those sort of standalone topics, but it sort of intersects with everything. And I guess the most common things when we talked about capital gains tax and all these sort of dates, when they're working with a planner, I guess it's trying to legally find ways to perhaps pay as little tax as possible. And
well, that to me, I consider that all part of my job, to minimise the impact of inheritance and make sure that money gets where it needs to go as whole as possible, so that we don't have to maybe pay that 15% plus 2% Medicare levy, that we can actually, as I said to you before about the woman who had cared for her son, and then we managed to claw back that 15% plus 2% that she'd been charged because she literally was caring for him. It's those sorts of things that if you speak to somebody like me, we're going to be all in on helping you minimise the implications. Sometimes I've said to people, now, just so you know that this particular asset is capital gains tax free to you while you're alive, but if you pass, that changes the status of it if it's still in your control.
Yeah, I guess hearing you speak, I always think of the phrase, we just don't know what we don't know. And someone like yourself sees things that we don't know.
Oh, well, let's put it this way. If I've got an uncle, God love him, I think he's amazing. He's got multiple farms that he bought pre-CGT and one that he bought after capital gains tax came in. Now, I know that if he sold the farms that don't have capital gains, we would pay no tax on that. He would pay no tax personally. But the day he passes away, that changes the tax-free status of those 3 farms and suddenly makes them all capital gains tax assets. These are things that most people don't even consider. So he's got multiple farms. So I don't know what they're worth, but let's assume, and I'm being very liberal in my assumption because I have no idea what a farm in the area that he lives in is worth. But let's say they were worth $5 million. Effectively, if he'd sold them, the 3 that are pre-CGT that are worth $5 million, he would get $5 million. But as soon as he passes away, they then become a CGT asset. So we then have whatever they're worth now as at date of death to whatever they're sold for eventually. Capital gains tax will apply there. So if they're sold in, say, 12 months' time for, and I'm using 12 months specifically, we would pay tax on $1 million if we were sold for $6 million versus the $5 million that they were worth as of the date of death. Then there would be capital gains tax for the estate.
Yeah, I like that example, and it ties it into where we started. Gayle, how can you be reached?
You can call me on 0407 159 298, or you can email me at Gayle, Gayle, at prosperityplanning.com.au.
Now, as always, this is information only and not personal advice. For our international listeners wishing to join our Facebook group, the code word is orange. And thank you once again, Gayle McKew.
Thank you for having me.